Welcome back. OPEC Plus has announced plans to delay production increases by 3 months. This decision comes amid sluggish demand and a perceived inventory surplus for crude oil. For more on this, let's bring in Rebecca Babin. She's senior energy trader at CIBC Private Wealth. She joins us from New York City. Rebecca, thank you for joining us as always. This was expected, wasn't it? OPEC has been kicking this down the road for a while, OPEC Plus.
Yeah, so this is the third delay from OPEC Plus in terms of unwinding their production cuts. And you're right, this was anticipated by the market. They basically extended their delays of the production increases by 3 months. What was slightly unexpected and could be kind of considered a bullish twist was the fact that they extended the timeline from 12 months to 18 months on bringing back the barrels to the market. So that kind of makes every incremental month going from 180,000 barrel increase and then in ratcheting up to 120 barrel increase and then ratcheting up from there. So it does have a modest impact on balances. And so some analysts will say, you know what, this brings the market kind of much closer to being in balance. But if you look at the bearish analysts on the street, they say no matter what OPEC does, even if they delay these production unwinds for the entirety of 2025, we'll still be in a surplus. So there's still a very negative sentiment kind of circling around the market, even with these adjustments made today, that we might still be in a surplus regardless.
What has OPEC looked at and seen and considered when it has taken this decision?
So I think they're considering several things. The first and foremost is the supply and demand picture. And when they look at demand, China specifically this year has really underperformed. And going into next year, they don't see a tremendous amount of growth coming from China. That doesn't mean we're not going to see demand growth. It's going to be about 1 million barrels a day. But when we look at the supply growth coming outside of OPEC, it looks closer to like 1.5 million barrels a day. So they're looking at that balance and they're saying there's just not enough room in the market for us to really bring these barrels back. Now, the other thing they're really looking at is what happens when Trump comes into office in January. And this is critical for oil markets in terms of how he decides to proceed both with sanctions and with tariffs. Those are kind of the two big pillars that have opposing impacts on crude oil. Now, the expectation is that he ratchets up sanctions on Iran and potentially removes 700 to a million barrels of crude from the market, which would really help OPEC Plus bring back their production in 3 to 4 months when they're scheduled to. However, if he also kind of moves forward with the tariff regime that he's talked about, we could see a dampening of demand growth just under the weight of tariffs specifically for countries like China. So that's kind of the next thing that they're considering. And I would say this meeting was an opportunity for them to buy themselves some time. But time is expensive for these countries, specifically countries like the UAE, who has invested in increasing production, and for Kazakhstan, who is supposed to increase production by 260,000 barrels a day this year for a massive investment in the Tengiz field. So the time is expensive, but they've bought themselves this time to see how the Trump administration plays out and maybe gives them some wiggle room to increase production and keep their members kind of in cohesion.
A lot of investors who are long oil securities are nervous about the so-called drill baby drill slogan that Donald Trump has put back into the conversation, that is encouraging more drilling on federal lands in the United States. That would be, many people believe, would drive a significant increase in production from the United States and further flood an amply supplied market in that narrative. You, however, doubt that narrative. You think that companies will remain focused on capital discipline and will not use their surplus profit and cash flow to put more drills in the ground.
Yeah, so I think there's a couple points here. And the first is, it doesn't mean production won't increase at all. Some of the kind of regulatory changes and the availability of federal lands will increase production, but not on a huge scale and not enough to move the needle. And as you mentioned, I think companies have learned a very hard lesson over the past 10 years that making investments based on that are going to take over 3 years to come to fruition, which was what we're looking at here with off-field oil services and kind of that component of production. Making that investment now with 3-year horizon, it just doesn't necessarily pay off. And they've learned that time and time again. So what they're going to do is potentially bring more money back to shareholders, increase their buybacks, as opposed to explosively increasing production. Now, again, on the margin, we may see some production increases where it fits, but on the whole, I don't think they're going to look at this as an opportunity to go back to drill, baby, drill. I think they're going to go and stay in line with the profits, baby, profits mantra that they've had over the past several years. I do think, and I do think a consideration is the fear that the U.S. production will increase significantly is a negative sentiment overhang kind of on the commodity. And if we see prices increase, there's always going to be that concern that, oh, this is the price where U.S. production does start to really increase. And I think that, along with OPEC's spare capacity, is really what keeps the lid on the commodity and really prevents rallies above, 80 or 85, as we've seen over the past year, from coming to fruition, even as several geopolitical factors have played out. So the sentiment factor of U.S. production increases will play a role in keeping prices moderated, even if those production increases don't actually come to reality.
Rebecca Babin, thank you a great deal, as always, senior energy trader at CIBC Private Wealth. She joined us from New York City. Coming up, Canadians are not happy about what Air Canada said yesterday about carry-on fees. We'll talk about it when we come back.